I claimed that assets equals liabilities plus equity. This balance, this symmetry is going to exist at every moment in time for a business. After every single transaction, after every single economic event that takes place in the business, this symmetry will always hold. So we can use this framework to account for transactions. That's what we're going to be doing. That's like the whole rest of the class. Okay. So a transaction is any event that affects the financial position of the company and can be measured. Okay. So something like, your biotech company, it gets a drug through phase 3 approval. Okay. With the FDA. That is going to have a big effect on the prospects of the company, but it's not measurable. Okay, so it's not a transaction. It is an event for the company for sure. You're going to see the stock price go crazy, but from an accounting perspective, we cannot really do anything with that because there's no transaction that happened because we can't measure the value of that event. Okay, so there has to be this idea of measurability. There has to be a dollar amount that we can attribute, at least estimate with good faith. Okay, it doesn't necessarily have to be an exact number, but we have to have a good way, a reasonable way to measure it. Okay, in order to account for it in our accounting system. We're gonna break down assets, liabilities, and equity into accounts. Okay, so assets. What are the different accounts? Cash, buildings, land, vehicles, investments. These are all accounts that are in the subcategory of assets, right? They're all assets. They're all different types of assets. Okay, so it is feasible that you can do all the accounting for your whole business with just 3 accounts: asset, liability, equity. Okay, but if you just showed that, like if your financial statement read assets and you listed all your assets, the total was 100, and then your liabilities were 20 and your equity was 80, you wouldn't know. The financial statement reader is like, well, what are these assets? How much of it is cash? How much of it is in vehicles? How much of it is investments? You don't know. Uh, you don't know just based on this balance. The balance is holding, but you as a financial statement reader are going to want to know more details. Okay, so the way we do that is organize our assets, liabilities, and equity accounts, our equity into accounts. Okay, so but theoretically you could just have these 3. Okay, so we're gonna go through some transactions, and I'm gonna prove to you that this symmetry always holds. Okay, so I think it'll be easier to see this when we kind of we have some solid transactions that we're accounting for. Okay, so this first one, company sells shares of common stock to investors and raises $10 million. Okay, so my claim is that after this transaction, this assets equals liabilities plus equity is going to balance. Okay, so what is happening? What are we getting? What is our company receiving in this transaction? 10 million in cash. So is that going to go on the left side or the right side? Left, yes. So I'll just say assets equals 10 million. Okay. Has my liabilities increased at all? No. So this is still 0. What about equity? Yes, this is 10 million because now my contributed capital is now 10 million, right? So this balance is holding, right? 10 million on the left side equals 10 million on the right. The way that we would have this organized is we're going to now have cash, 10 million, equals no liabilities, and we have common stock. That's the account for this. Common stock, 10 million. Okay, so now we have a little more detail. What are the accounts that were involved in this transaction? We have cash asset equals common stock, which is an equity account, and we can kind of see a little more detail of what happened. Okay, so now let's go to the next transaction. So this is going to carry forward, okay? This balance is this is our current balance of the company. Okay, so now the next transaction happens. The company buys land for 3 million. Okay, so has anything happened on the right side of the equation? Has anything affected our liabilities or equity? Has this transaction affected either of these classes of accounts? No, we're not borrowing any money, or we're not borrowing anything, and the owners have neither made a profit, or there's no revenue, there's no expenses, they haven't contributed any more money. So this right side of the equation is unchanged. Okay, we're gonna have 0 here, and this is gonna be 10 million. Okay, what about the left side? What's happened here? What's our cash balance? It goes down, but what did we get? We got another asset, right? We just traded one asset for another. We traded cash for land, right? So this is still 10 million. The total is still 10. Okay, so how is this broken out? We have cash, 7 million, land, 3 million. And then this is the same. Common stock, I'm just going to shorthand it, 10 million. Okay, so this balance is still holding. Okay, let's go to the next one. The company provides services to its customers and bills 500,000. Okay, so what are we? This is a little tricky. What are we getting? What kind of what are we receiving? What is that? Promise to be paid. What do we call that? I think we did mention it when we talked about assets. What is, accounts receivable. Okay, so on the assets, now we have cash, 7 million, land, 3 million, accounts receivable, 500K. So I'll just put 0.5 million. Okay, so now as it's a total of 10.5 million in total assets equals, we didn't borrow anything, so the liability is still 0. We have 10 million in common stock. Okay, so right now we're not balanced, right? What part of equity is not included here? What did we just do? What was this transaction? Like what was the economic kind of reality of what happened here? We got this account receivable. What did we do? Yeah. So we generated a revenue here, right? And as we saw in our thing here, in our schematic, within equity, we have contributed capital, that 10 million, and then revenue is also an increase. Essentially, a positive here is a positive to retained earnings, which is a positive to equity. We now have common stock 10 million, and then we have revenue 0.5 million. So now on this side, we also have 10.5. Okay, so we still are balanced. Does everyone see this pattern? Yes, it's starting to make sense a little bit. Okay, so let's do this next one. The company pays salaries to its employees of 300,000. Okay, so what did we pay with? Cash, right? So our cash, our assets are going to go down. Agreed? Okay, so we'll have cash. We had 7, but we just paid out 300,000. So it's like 6.7 million. We have our land of 3 million. We have accounts receivable, 500K, so 0.5 million. And yeah, that's it. So now we're back down to, what is this? 9.7, just reduce this, so 10.2, right? Agreed? Okay, equals 0, nothing on the liability. We still have common stock, 10 million. But now we have revenue, 0.5 million. But now we have a negative amount. Okay, so we saw here contributed capital, this increases equity. Revenues increases equity. But these two, expenses and dividends, they are decreases to equity. Okay, they're reducing equity. Okay, so we have now expenses. This is negative 0.3 million. And so on this side, we now also have 10.2 million. So we still are balanced. Okay. Transaction 5, the customer pays the company for those services, right? So we have that account receivable that was created. Now that customer is going to pay us off. What are they going to give us? Cash, right? Okay, so our cash is going to go up by 500,000. So we're going to have cash of 7.2 cash. Our land is 3. What about this account receivable? Do I still have it? No, they paid us off, right? So that account receivable represented an amount that that company was going to pay us in the future. And when they actually do it, they no longer owe us any money. It's no longer an asset for us. We just converted the account receivable asset into cash, right? So this kind of goes away. So our accounts receivable is 0 now. So we're still at 10.2. And nothing really changed on this side. Okay, so this is still 10.2 also. All this stuff is 10.2. So we're still balanced. Okay, everyone get that? Everyone cool with that? Okay? Okay, so now the company purchases equipment using a loan from the bank. So now we're gonna like mix it up here. Okay? So we're gonna get equipment, which is what? Is that on the left side or the right side? What is equipment? It's left side, it's an asset, right? So we have cash 7.2, we have land 3, and then we have equipment that we're now having $1 million. It's equipment. Okay, so now we have 11.2 in total assets. Liabilities, we just have a new one, right? We just added 1 million in liabilities because we financed the equipment with a liability, right? So we now owe the bank this $1 million. We got something for it. We got this asset, but we now have a liability of 1 million. All the rest of this stuff is the same. Nothing's changed here. Okay, so we still have 10.2 million in equity. So this is also equal to 11.2. I need you to be convinced that this is the case. After every transaction, this is always going to hold true.